Jurrien, wonderful to see you. I hope you had a good Thanksgiving weekend.
Well, welcome to the show, Glenn. Nice to see you as well.
Nice to be here. Jurrien, actually, let me just remind our viewers, if you have any questions, please do send them in. There's so much that we can talk about today, and we only have 30 minutes, so we'll get right into it. Jurrien, it's Cyber Monday today, so welcome to Cyber Monday. There's a lot on sale, but the market is not on sale, and December is typically one of the best months historically. What do you think as we now head into this month of December?
Yeah, so let's pull up slide one. So the bull market is now 26 months old. And if I just review kind of the clock back to January, which now December, one of the milestones in January was that the S&P made a new all-time high for the first time after, going through the 28% correction or bear market in 2022. And when the market makes a new high after a bear market, usually the momentum becomes very strong. So typically the market goes up, 60, 70% of the time by 10, 11%. But when a new high is made after a correction, the odds go to like 90% and the returns become much better. So fast forward, that's exactly what's happened this year. So in that sense, the market has followed the typical sort of technical playbook. And so at this point, we're 26 months in, we're in the third year of this bull market. S&P has rallied about 73% from that October 2022 low. The equal weighted is up a little bit less than that. Small caps are up less than that, but still everything has participated. And what we're seeing on slide two is that the market has actually broadened a little bit, which is nice to see. So in some ways, this is a very typical bull market. It gets more expensive as it gets older, and you mentioned valuations, and that certainly is becoming a higher hurdle. But at the same time, the market actually has gotten broader as it gets older, and that is not typical. Typically, new bull markets start very broad with lots of breadth and participation, and then as the cycle matures, the breadth starts to come down, and it's only sort of the big blue chips that are hanging out towards the end. And we've seen the opposite of that. So the market has broadened. The percentage of stocks beating the index was at 26% last year. It's up to 41%, which is still not great. The norm is about 50%, but it's an improvement, and that's a good sign. So, and as you mentioned, the seasonals are the most favorable from mid-October until, let's say, April, May. And so we have December, we typically get a Santa Claus rally. Certainly, we got the Black Friday rally, which is also fairly typical. So there's a lot of momentum in the market. And if I pull up a monthly slides 6 of the S&P equal weighted index, so this is purely a technical chart, there's not a lot not to like here, right? You have a rising trend line. The market has followed that trend line. It's slightly above it, but not a lot. Again, this is the equal weighted index. And 77% of stocks in the index are above their 200-day moving average, which is another way of saying they're in long-term uptrend. So you have a strong trend and you have very good participation. But as you point out, some of that is starting to come at a price. And even though, so if we go to slide 11, even though the equal weighted index remains at okay valuations around 20 times, the cap weighted index, is really getting sort of into the nosebleed area. And of course, that's the Mag 7 and the mega cap grower. So, valuations are a poor predictor of short-term returns, but it does indicate a falling margin for error, if you will, that if a company misses earnings and is trading at 25 instead of at 15, more will go wrong with the price.
The falling margin for error point you just mentioned, I wanted to talk about vulnerability. There seems to be a lot, with the coming change of administration in the United States, there seems to be a lot that's based on potentials. What's going to happen with tax cuts? What's going to happen with tariffs? what's going to happen with crypto freedom. Is there a lot of vulnerability baked into that because of the bets almost that are being made that these things are going to come to fruition?
There's always vulnerability, and of course, with this administration that's coming in for the second time, we know better than to think that we've got him and his team figured out. But in 2017, a lot of the Trump trade, if you will, was priced in fairly quickly. I mean, that's what the market does, right? It's brutally efficient in pricing in all available information. And 2017 was a good year. So that was year one of Trump one. And of course, we had the tax cuts and earnings were booming, but valuations also expanded. But that was a different market cycle, right? I mean, inflation was non-existent. The Fed was just coming off the zero bound. So interest rates were very well behaved. And so it was really just a lot of tailwinds. And the tariffs didn't really bite. I mean, there were tariffs, but it was mostly rhetoric at that point. Now we have Trump 2 beginning, of course, in January, although by looking at the headlines, it sounds like he's already running things, meeting with foreign leaders and everything, which I guess is a good thing. But of course, inflation is higher, rates are higher. The Fed is coming off of a cycle peak, right? Having gone from 5 3/8 to now 4 5/8, and we can pull up slide 20 for that. But my concern, so a lot can go right? I mean, the tax cuts can be extended, although an economist will tell you, when looking at stock versus flow, that extending tax cuts is really not fiscal stimulus, right? Because the tax cuts are in place, people have adjusted their behavior, so not extending them would be a fiscal tightening, but extending them is not a fiscal easing unless they get lowered from here. So, and no one's really talking about that. And I think there's enough responsible adults, even in the Republican Party in the Senate, that really, run amok fiscal policy is probably not going to happen. So we won't really get the fiscal impulse that some people have thought about. But we could get a capital formation cycle, animal spirits, as they're called, less regulation or less enforcement of existing regulation, and that might, entice companies, especially smaller ones, to build for the future. But then of course you have the tariffs, potentially offsetting that. What does that do, right? Is that inflationary? Does that reduce profit margins? To what extent can they be offset by, for instance, a rising dollar, right? If you're importing from other countries and the dollar's rising, that's an offset to potential tariffs. So there's a lot of variables here, but my biggest, not worry, but one thing that I don't think is really appreciated, just to go back to that Fed chart, is that if the Fed didn't quite slay the inflation dragon, right? So we're stuck at the high twos. The core PCE just came in at 2.8, up from 2.65. Core CPI is also proving to be kind of sticky. So the Fed obviously has made a lot of progress getting the inflation rate down, but if it can't really get it down below 3 or very much below 3, then and the economy, let's say, reaccelerates next year as all of a sudden these animal spirits return, could we actually see another upwave in inflation, or at least not any further improvement? And if that's the case, then maybe the Fed actually is already done cutting rates. If you look at where I wrote there, neutral should be above this range. If neutral is inflation plus, let's say, 100 basis points, and that gets you to high threes or 4. Fed's at 4 5/8. It's expected to, well, actually, it's not necessarily expected to cut in December, but the Fed is meeting in a week or so, and the odds of another rate cut are about 66%. So the market is marginally expecting the Fed to cut. But my sense is that the Fed is very close to already being done, unless the inflation data improve. And if I were the Fed, I would hold off here because we don't know what the economy is going to do next year.
So it is a big question. What is the Fed going to do? Are they done? And it takes me to the Eurozone because now they're running ahead of target. And so, and yet they're saying collectively, we still look like we're going to be bringing rates down. What do you think?
Yeah. So, again, when you look at the history of the inflation rate, right? So the average, we know the average is 2, and the pendulum is always swinging above it and below it. And the result is you get an average of 2. Um, so obviously inflation went way above it in 2022. It is still above 2 now, obviously much better than it was, right? The CPI went from 9 to 3. But if we don't overshoot it to the downside and then a new wave emerges to the upside, then like the 2-year average, the 5-year average is going to end up at 3 or 4%. And we can look at page 20, slide 21 here, where I show a monthly chart of the Fed and the 2-year average rate of inflation using the CPI. And that's, it's gone from 6 to 3.7, which is good news. But 3.7 is well above 2, and it's actually above where the market currently thinks the Fed is going to ease to. And again, I think that's a risk. And we saw that in the 60s. And I'm not suggesting we're going to repeat the great inflation of the 70s because the Fed is much more restrictive now than it was then. But back then, inflation perked up with the Vietnam War and guns and butter, et cetera. And then it came back down, but it only came back down to the average. And then it had another upwave. And then it came back down, had another upwave. And the Fed was behind the curve back then. And I think the Fed has learned from that and won't repeat that mistake. But that's why I think the Fed is probably going to be more inclined to kind of hold off from cutting more. And then at the same time, we have the long end of the bond market, of course, slide 22, where the bond market is now better behaved, primarily, I think, because of the nomination of Scott Bessert at Treasury, who is more of a deficit hawk, and he wants to grow the economy out of debt rather than just sort of devalue it. So the market likes that. But and for now, the 10-year yield sort of holding in this falling wedge that you see there. But I do think that we're going into a landscape that we have been in for the last 2 years, where you get these occasional flare-ups in the term premium, which is the risk premium on long-term bonds. And we're not seeing it right now. We're at 4.18, very well behaved, but 4.5 to 5 is not out of the range of expectations, and that could occasionally cause a wobble in the market next year. So I think the rate side, the inflation side, is one way that this cycle could be different from Trump 1 back in 2017.
Tariffs are something we read about constantly. And because you're director of global macro, not just director of US macro, when do you think, for those foreign nations that are so reliant on what's going to be happening, when will we know what's going to happen? How long will this take?
Including our colleagues to the north.
Exactly.
In your backyard. I mean, that is one of the big questions, of course, is how much of this is bluster and bluff poker and a big stick that he carries around to extract better deals, and how much of this is just we're going to impose tariffs and punish everyone. Obviously, no one really knows the answers, but my sense is that, again, you ask an economist about tariffs, if you're a U.S. importer, it raises the cost of your imports. So you either pass those along to consumers, which is inflationary, or it comes out of your profit margin, which affects earnings. Or there are other offsetting things, like I said, with the dollar, for instance, or more supply response, right? And I think one of the hopes of the Trump administration is that companies will onshore, supply chains will be brought back, those Rust Belt cities thrive again. But those things take time and they're inflationary, right? If you're duplicating supply chains, that doesn't come without a cost. Especially if you're also going to deport people, right? So there's a lot of variables here that we just don't know. And of course, for instance, like the deportation, like that has to be done through states, and some of the states are blue and they're not going to just go along with everything. So it really remains to be seen how much of these things um, are actually going to happen. I think the one thing that we can sort of count on is that there will be less regulation or less enforcement of current regulation. Obviously, the borders will be much tighter, and we already see what he's doing on the tariff side, at least threatening tariffs, 25% on Canada and Mexico, and of course. A day later, he has a conversation with the Mexican president. He had a conversation with your president. So you can see that this is part of an ongoing series of negotiations, and hopefully we all end up in a good place.
You were quoted a lot last week in various publications about the crypto world right now. Do you want to take a few minutes to talk about your thoughts there?
Yeah, so obviously this administration is considered more crypto friendly. What that actually means for Bitcoin is not clear at all because if you incentivize local innovation, or U.S. innovation for the blockchain and DeFi, like the disintermediation of financial institutions, even some regulation on stable coins, which is long, long overdue. And I think that is more likely to happen, which is very important because the stable coins are very important rails, into that blockchain world. And in many ways, you can argue that stablecoins actually have more value than Bitcoin or other tokens because that is kind of this system of rails that actually will extend the reach of the almighty U.S. dollar, right? And so, in a way, it's good for the dollar if you're a strong dollar, advocate. For Bitcoin, it's kind of interesting. There's so many religious, I don't call them fanatics, but it is kind of a religion, and some of the things you see don't really make a lot of sense. I've seen people say the Treasury should have Bitcoin as a reserve asset, and I don't even know that the Treasury has reserve assets. That's the Fed, and the Fed's not just going to put Bitcoin on its balance sheet because it's just going to make them look bad. It's like, yeah, we can't manage the house, so we're going to put a strong currency in there. So a lot of this I take with a grain of salt. And even Robert Kennedy Jr. was saying Bitcoin should be a strategic reserve to offset our declining purchasing power. Well, he's actually in the administration that oversees the purchasing power. So that doesn't make any sense. It's one thing to be in the opposition and say that. So I take a lot of that with a grain of salt. There's a lot of speculative buying going on. Obviously, the strategy is very interesting and unique. But you look at the ETF flows, you look at futures, there's a lot of people riding that train just thinking it's going to go up and I'm going to ride it. And at some point, those people will get flushed out like they always do. But for now, it's certainly an interesting ride, and we're still knocking on the door of 100K. And so the models I created 4 years ago that were maybe laughed at the time are actually looking pretty good right now.
There are ETFs, from my understanding, that are derivative based that are connected to crypto and connected to MicroStrategy that can be extremely volatile either direction, and people are loading up into these assets, and so that vulnerability probably does creep in when you think about the type of investing that people are doing. And even thinking of something, from my understanding, like Dogecoin, which was created as a bit of a joke, but because it sounds like the Department of Government Efficiency, it rallied because that's a new acronym.
I mean, you have the adults in the room, which are Bitcoin and Ethereum and maybe Solana, and then you have what are called altcoins, and other people have a less flattering term for them, but which will refrain from here. And it's like the S&P goes up 1%, the Nasdaq goes up 2%. I mean, it's the same idea, right? It's people jumping on the bandwagon and running it, and that's what creates this interesting phenomena that we see in the crypto space. But I do hope that the innovation happens, especially on the blockchain side, on sending money to other parties without the banks taking a share, and especially stable coins. I think that's a very useful thing, and I think this administration will be much less inclined to go the route of a digital dollar, the way the Chinese have. And I think a lot of Bitcoin people will be happy about that because, the Chinese uses it to control people. So I don't think we're going to go there, which is probably a good thing. And you don't really need it. The Fed doesn't really want it anyway. But it's good to see. I think people are generally happy that Gary Gensler is leaving the building, although I do have to say he did approve the ETFs, almost a year ago, and that in many ways is already a seal of approval that Bitcoin and now Ethereum are legitimate, assets. And whether you like it or not, I think Bitcoin has proven itself to be at least worthy of being on the menu. Whether you actually choose it from the menu is up to what you think about it and your risk tolerance and all that side. But after 16 years, still standing, still making new all-time highs after three sort of nuclear winters, that means a lot because bubbles, once they die, they stay dead, and this one keeps coming back.
You mentioned China a couple of minutes ago. Let's talk about commodities. With the stimulus that China keeps putting behind the economy to get it going, will that potentially be a boon for commodities in 2025?
So what China, I don't think so. So the old days, since since the early 2000s, especially after the financial crisis, China would stimulate whenever its growth rate started to stall, below 6%, it needed to push it again because there was so much debt being built up that you need to grow. Otherwise, the house of cards falls. And they would do stimulus, which was infrastructure related, housing related, and that would obviously drive the demand for raw materials. And so whenever China would stimulate, it would cause a commodity boom. And we haven't really seen that lately because China has basically built everything. So now their stimulus is more on the fiscal side to promote consumer spending among its citizens. People in China save a lot because they don't trust the system, so they're not spending their money. And so the fiscal stimulus today is more about propping up, falling housing prices and incentivizing companies to buy back shares. So it's more financial and less infrastructure. And so I think that's a different story. And it has knock-on effects, of course, but not so much in the commodity space. And that's why, gold has risen, oil does what it does, but the commodities sector in general has really not participated in the rally of most assets over the last couple of years.
And let's pick up on gold. We had a question come in from one of our viewers on your thoughts on gold right now.
So gold is a store of value. It's proven to be that for, well over 1,000 years. Bitcoin is trying to play on that team, and I think it's doing a reasonably good job. But gold doesn't have any bells or whistles, right? It's just gold, nothing else. No one's going to pay for their groceries with gold. But it is a store of value, and it's proven to be a store of value. And I think what the rally in gold was about, and still is, but gold has come down in recent weeks as Bitcoin has sort of taken the stage. And they're kind of like a tag team, right? They kind of trade off of each other. But I think what gold is telling us is that the Fed is now in an easing cycle. My guess is it'll be more limited than expected, but the money supply is growing again. And if we have many years of fiscal expansion still ahead of us, especially if it's offset to some degree by the central bank, then gold should do well because gold is a play on monetary inflation, on real rates. And if the Fed tightening cycle has peaked while the fiscal side continues to grow, that's a more favorable outcome for gold. And Bitcoin, of course, is a play on that as well. But Bitcoin has all these other features. Gold doesn't have a micro strategy that is selling convertible bonds to buy gold. So Bitcoin has its own set of features that makes it basically exponential gold in both directions. But for me, and this is just my own personal view, a diversified portfolio, should have some bucket of hard assets, whether it's real estate or gold or Bitcoin or all of the above. And then it should have some negatively correlated assets, which used to be bonds, but they're now positively correlated. And then you get into the alternative space, which, of course, we were talking about just last week or 2 weeks ago in Scottsdale as well, where you don't get the negative correlation, but you do get non-correlation. So you get more or less a zero correlation. And I think, gold, Bitcoin, managed futures, alternative risk premia, long short equity, all of those little buckets, I think have a role to play in a diversified portfolio alongside gold and other assets.
Quick question on autos. The Stellantis CEO stepped down yesterday. What else would you do on a Sunday? Volkswagen's got labor disruptions. But back to China, they seem to be exporting and having a very robust auto sector right now. Do you see that continuing? Do they take over from an auto space standpoint?
Well, they're not going to take over in the U.S. because there's already tariffs on those autos. But Elon Musk produces a lot of cars in China, so it'll be interesting to see, assuming that the bromance between him and Donald Trump continues, to what degree Elon might be like a broker, in China to kind of circumvent the headlines about tariffs. So maybe there's some backroom deals there. But it's very interesting to see that. Autos, we still all drive cars, and even though I don't drive as much as I used to, and so the automakers will stay around, but it's not a sexy new industry like AI.
Right. There's talk of a 24-hour stock exchange happening starting next year in the United States, 24X National Exchange, I believe it's called. Does that add to more speculation, or does it add to efficiency within the market? Any thoughts?
I don't think it really matters. Like, right now Bitcoin is 24/7. And so on a Sunday morning, if something serious happens in the world, Bitcoin is your early proxy for either risk on or risk off. And then, of course, at 6 p.m. our time, the futures market opens. Most of the volume happens, right at 9:30 when the market opens, or right before the market closes. I mean, like Fidelity, that's usually when we are trading. So yeah, it's like having a 24/7 futures market. But my guess is that the serious trading will happen during regular hours when the volume is there. So it might create some noise and volatility, like a Saturday night, somebody decides to play a game and ramp the market. And we've actually seen this in gold for years. Someone like at 3 a.m. London time, like dumps 1,000 ounces or whatever of gold and moves the price. But painting the tape is what we call it in technical land. But ultimately, people are wise to that, and the volatility will even itself out. Ultimately, the fundamentals drive the price, and I hope the markets actually don't open on the weekends, because it's a nice respite from all of the drama that we have to endure here.
Well, we'll see what happens next year. And Jurrien, I've got millions of questions I could ask you, and so do our viewers, but we've run out of time. And I do hope that our viewers are connected with you on LinkedIn, and they've also subscribed to your weekly asset allocation report that comes out. I find it very valuable, and I know thousands and thousands of people do, and I'm glad you've made that available. So to our viewers, sign up. Thank you, Jurrien, for being here, and enjoy the rest of your Cyber Monday.
All right. Thanks, Glenn. Pleasure to talk to you.